little bit a sort of little changed. One might describe it as moving up and down 15, 20 cents. Ultimately, after the big drop off yesterday, with the threat of the US release of SPR. The market seems to be a little nervous about that. Let's kick off this morning, as always, on a Thursday morning with Carol Nachley, CEO of Crystal Energy, back in the UAE, as Irene said, back for ADIPEC, the world's biggest energy exhibition and conference, due to be returned to life next week. Let's hope it all turns out well for everybody. Carol, welcome, and welcome your thoughts on the outlook at the moment. The US government in a bit of a standoff with OPEC. Is it a bit of a storm in a teacup for you?
Good morning, Sean. Good morning, everyone. Well, look, I don't know. I'm not quite sure how to read President Biden, because he seems to be all over the place when it comes to oil policy in particular, if they have anything defined as oil policy. Because I think the main problem that the US is facing is inflation. And of course, gasoline prices play an important role, but to blame it all on OPEC is, for me, too simplistic. So there is more to it than just a standoff between the US and OPEC. Of course, the US is always looking for another party to blame whenever something goes wrong domestically. And here OPEC has given them the right excuse, because it is true. OPEC policy has contributed to prices to where they are today. But honestly, Sean, when you look at the macro picture beyond the oil sector, let me just throw at you some numbers that came out over the last few days. And this is pretty worrying for the global economy and for the oil sector as well. So if you look at the consumer price index, which in the US, which is a reflection of how fast prices are rising in the US in terms of impact on consumers, they were the highest or the fastest since 1990 in the US. And in September, they were 5.4%. In October, they registered 6.2%. Now, that will cause serious headache for the Fed, because the markets are now expecting the Fed to accelerate its tapering and even reconsider raising the interest rate earlier. But it's not just the US. Look at China. There was a factory gate price, which the wholesalers pay for the suppliers of materials. It was the fastest in 26 years. Germany, another big economy, the inflation rate hit the highest since in 28 years. So really everywhere we have a problem of rising prices. Energy, of course, plays a role into that, but to blame it all on OPEC and to reduce it to the standoff between the US and OPEC is really simplifying a much more complex problem.
Matt Stanley, Director of Star Fuels. Welcome back to the table, Matt. Two notable comments this week, Matt, that I think have gone somewhat under the radar, and yet I would think has to be significant. Russell Hardy, CEO of Vitol, Marco Dunan, CEO of Mercuria, two of the world's largest independent oil traders, telling us that we're already back to 100 million barrels of oil market a day, or there or thereabouts. That clearly is a significant piece of information if it's true. Your thoughts on those comments and why it isn't sending a rocket in the market?
Well, I mean, look, if Russell Hardy and Marco Dunan can't be bullish, then no one in the oil market can be. I mean, it's in their nature; they have to be. But Mr. Hardy's comments were interesting, because it was only 3 weeks ago that he saw prices sort of topping out at 75, and now he's increased that by 25% in less than a month to $100. I think in the short term, the rhetoric is the same, in that the world is still in somewhat of an energy crisis. But I think Dr. Carroll was spot on. It's refreshing to hear these issues being raised to the fore, in that the world is facing significant headwinds. And your halftime talk this week with Russ Edwards, which was excellent, you hit the nail on the head with him, when China has now become a matured economy, and we can't just look at 6-7% growth there, 4%. Look, in the short term, the next 3 months, I wouldn't be surprised. I think we get to 90 by the end of November. I think yesterday was purely some profit taking. There was some buying dips that were taken out end of last week. We've been in a range between sort of 82 and 86 for about a month now. It's been fairly boring, to be honest, Sean. OPEC are over the moon, 85, and they're very, very happy, as I'm sure Walter is. But it's next year where this can is being kicked down the road, where we will be in a surplus. You know, OPEC balances will come back in. The US will start producing more oil. They were steady last week at 11.5. In the short term, I can't deny that 100 is likely by Christmas time. Unfortunately, it adds to the inflationary argument. But I see Q1 next year it really coming off after the winter buying season. But you know, who's going to argue and get in the way of a runaway train like Vitol and Mercury?
Walter Simpson, Managing Director of CCED, an independent operator in Oman. Walter, one of the underpinnings of this market has to be stories like we see in the digest today out of Russia, where Russia's oil and gas discoveries fell to their lowest in 5 years in the first half of 2021. I mean, basically, nobody's looking for oil, new oil, nobody's finding it, and very few are actually investing in developing it.
Simple answer to that is yes, to some degree.
Except for you, of course.
Well, yes, we are, but you know, it's only recently we tried to keep spend going through the period for that very reason, that we knew when things come better, you need to be ahead of the game. But I think it's true when you want to curtail capital spend, exploration is a very easy area to do that. Doesn't necessarily hurt you in the moment. It's later, and I think that is going to come to bite us. I think that statistic from Russia is reflection of not spending the money. And I think that's compounded across the majors with the move to green energy, and the capex being diverted to that is reducing exploration as well. So yes, I think that's going to compound the markets going forward, less new supply coming into the market.
On that point, Walter, we are coming to the end of the COP26. Do you hear anything coming out of there that should be of concern for oil producers? We saw a somewhat surprising, rare agreement between China and Russia yesterday. China and the US, rather. Lots of agreement between China and Russia these days. But between the China and the US, it seemed that they were willing to sort of find some consensus on the COP protocol, the COP sort of final paper.
Yeah, look, I think it's quite interesting. You know, the rhetoric is that there's deals being done behind the scenes, and certainly what you're reading at the moment is there's going to be announcements, and certainly coal is going to be curtailed, although the big coal users didn't necessarily sign up to that. Look, I think that as a transition fuel, there's a really good place for gas, and you know, replacing coal with gas in the short term has got to be something that people need to look at. But what I guess one of the reflections I've got is the speaking, you know, speaking at COP about controlling hydrocarbons, and even the EIA's announcement about not investing in them, but yet at the same time you've got the politicians wanting more supply. So I think when the rubber hits the road, we're going to see maybe different actions from what the rhetoric says. People don't like paying more for energy. And when politics comes into it, that has a very strong impact.
People don't like paying more for anything, but they are at the moment. Even in India, we're seeing oil products being consumed at 7-month highs, record prices. And Carol, as you pointed out, we have overnight a really big data point. US consumer prices jumped 6.2% in October, biggest inflation surge in more than 30 years. Has Jay Powell lost control of this market?
I would say not yet. At least that's what they're trying to tell us. Because also, if you looked at a statement made by the Treasury Secretary Janet Yellen, she repeated what Powell has been saying, that this is transitory and hopefully to be resolved by middle of next year, so half of 2022. This may be true, but when I hear these kind of statements, I wonder whether consumers can sustain this kind of additional pain for so long, because yes, on papers and for economists, 6 months is nothing when you're taking the longer term picture into perspective. What about the average person in the street? And politicians are quite sensitive to the reaction of, you know, the average person in the street. So that raises the kind of, if you want, a dilemma for politicians. On the one hand, they want to rely, and maybe they should trust their economists, but at the other hand, they have to respond to the need of the consumers. and we might see more and more, this kind of signs of discontent emerging from the side of households, and that would put pressure on the government. Of course, the central bank's policy is independent of the government, but at some point something will happen, because I'm not quite sure we can sustain this increase in prices. And also, Sean, just psychologically, when it was 5.4% in October, people, just like when you go and you buy an item and they tell you it's 9.99, immediately you would think it's closer to 9 than it is to 10. But here we're talking about 6.2%. So you already exceeded a certain threshold. And that's where the market reaction yesterday reflected concerns that the central bank, the Federal Reserve Bank of the United States, might well accelerate its tapering and even revisit its increase of interest rate. We have to wait and see.
Carol, just a quick follow-up. Do you think we should care whether Joe Biden, who apparently is about to announce whether Jay Powell keeps his job or not, big moment? What is your thoughts on that?
Again, this is my personal opinion, that I don't think they would risk taking any major shakeup to the establishment at this critical time. And Jay Powell, to be honest, has a good track record. So I'm not quite sure that this would be a clever step to make. But again, better than me about politicians, they can be pretty unpredictable. They want to secure votes, and that's what matters for them.
I think it might be too tempting to, put in your own person rather than renew Donald Trump's person. That might be the temptation for Joe Biden. Matt Stanley, should we read in much? We saw the market move up during the week on API numbers, move down on EIA numbers, or your thoughts on the inconsistency there? Inventory is clearly still drawing on the trend line.
Look, it's been the last sort of 6-7 weeks. Crude has drawn, Cushing has drawn. It's been supporting the markets. Yesterday we saw a build, a negligible one on crude of about 1 million. We saw draws on Mogas and distillates. Look, coming into Thanksgiving now, so the market will need that push. Next, I think it's in 2 weeks' time that the US will be tucking into Turkey, and hopefully that gives that ramp up in gasoline demand that is needed to push it higher and higher on WTI, maybe break 90 by the end of the year. But it's if you look at excuse me, if you look at the wood for the trees, look at the real sort of bellwether for product demand and where sentiment is. It's the 3-2-1 crack we call in the US, which is 3 barrels of crude in, 2 gas oil out, and 1 gasoline. That's a 5-month low. So it goes to show you how much confidence the market has got at the moment in end user products. Refining margins are struggling. Fuel oil, especially over the last month, has had a torrid time. It's all to do with the gas crisis, and the more that eases, Russia has started to flow gas into Europe now. Stocks are at 80% of levels that they were this time last year. It was an issue that the market had. Remember in January, I think Annette, your colleague Annette, had a talk with Tellurium. And even in January, they said then to Annette that the world is facing a supply issue when it comes to gas, and we are in the danger zone. That's what Martin said. Nothing happened. As Walter said, okay, well, there's no investment in fossil fuels. Well, my daughter needs crayons and I need to put gasoline in my car, right? We all still need to consume oil and oil products. And we can't moan about the fact that prices are high when you're not investing in the thing that we all consume. Now, that comes essentially, that manifests itself down into weekly stats and what crude oil stocks are looking like in the US. I largely think it's being dismissed at the moment by traders. It's more the underlying rhetoric around the energy crisis that is causing markets to be so supported. But for a weekly boost, they will look at those numbers.
Walter, the other thing that's sort of giving volatility to the markets this week, of course, is the potential threat that the US government would release from the Strategic Petroleum Reserve there. And it would seem to be in some reaction to the fact that OPEC Plus did not respond with increased supply. But also in response to the fact that OPEC Plus isn't even meeting its current supply agreement, i.e. 400,000 barrels per day per month. Your thoughts on whether the US could release from SPR and make up for that inability of OPEC Plus to meet 400,000 barrels a day?
Oh, I think it's back to it's politics. They're clearly, with inflation where it is, with energy prices being a significant portion, I wouldn't say the driver, but a significant portion of that, I don't think you really have a choice, is the honest answer. You've got to try and get supplies down and moderate the price. I think they're going to, and I think they probably should from an internal perspective, to be honest with you, yes.
I mean, it does look currently, putting aside one or two big producers within the OPEC Plus group, that there is a challenge there. They're having difficulty, many countries, meeting the existing quotas, never mind next month's or the months after that.
Yes, is a simple answer to that question. I think most of the OPEC Plus countries are producing absolutely everything they can. And there's a very small minority of really maybe one or two, I think, who have extra capacity. And they're the ones that control the market. Well, we've talked about that before, and I don't think it's any surprise who they are.
It certainly feels like there is a question mark there as to where that can go into the new year when clearly there's new quotas coming and other such things. Carol, we're looking at a question mark within the demand side. And was mentioned earlier by Matt that China is slowing down. The China demand numbers for October were lower than the previous months, although there's some speculation that they may come back. Where do you think China is going as we come towards the end of the year as an engine of demand growth for oil that we've seen over the last decade?
Yeah, China, I mean, if I want to focus only on the very short term, I'm not expecting drastic changes. On the contrary, I think in China, what there is this week, I think they have the world's biggest shopping festival. So that may give some boost to the demand. But really, it's again the longer term picture that matters in China, and the macroeconomic situation in China, the inflation, the problems, the structural problems that were already there even before COVID-19 hit, raised some question marks about the growth rate of the economy in China and as well as oil demand. But I want to go back to a point you said earlier, Sean, because that left me a bit puzzled about the inventories built up in the US or draw, because the EIA clearly said that they had crude inventories in the US rising for a third straight week and actually reaching the highest since August this year. And to go back to this issue about the growth in demand, it's not only what happens between now and the end of the year. I mean, really, you'd expect some major changes in the fundamentals to see prices breaking away from the current levels of where they are. But it's the question of next year, whereas major forecasting agencies and financial institutions, everybody seems to be in agreement that next year we're going to see supply growth outpacing demand growth. And even they're expecting a slowdown, relatively speaking, to the demand growth. So I would be cautious about, what's the outlook for demand in China in the short term and also in the longer term.
Matt, your thoughts on that vis-a-vis where China goes? We're seeing question marks over their exports of products into Asia, where refinery margins are that do seem to have a healthy recovery, and all of the producers led by Saudi piling on with higher OSPs.
I just want to touch on something that Carol just mentioned about inventories, and closer to home, we saw a meteoric rise yesterday in Fujairah stocks. It really took the fuel oil market by surprise. They were up 3 million barrels last week by 42%. Now that is a gargantuan amount of fuel oil in 1 week to be discharged into Fujairah. That's going to have a big effect on 0.5 premiums within the region. They've already been struggling recently. I mean, they've just about been above sort of +1, +2 over the last sort of 3 or 4 months. They're a bit stronger now, predominantly.
Why do you think? What would be an explanation for that?
Well, the 0.5 strength predominantly came from a sort of hangover from the summer when Pakistan shifted from buying gas to buying fuel oil. So that supported the fuel oil structure and complex in general. They were still looking to buy some October fuel oil, but now that gas prices have come off somewhat, they're back to buying gas. So, and then you had Kuwait. There was a big refinery in the Min Al Hamadi refinery in Kuwait. That meant that coke was down, so they couldn't produce any 0.5. So they were selling all their high sulfur. So what you've had this manifestation of fuel oil, end of summer buying season, and it's gone up 40%. I think that'll have a big effect on the complex in general. That'll drag down the residual part of the barrel. It will drag down crude. So I think that was part of the reasons yesterday there was sort of gloves off and risks off. And as Carol said, there is a lot of confusing and contradictory data. It's all there, but you really got to search for it. You've got to sort of really look for it properly and look at the back page before you look at the front page, because it's not good. The headwinds are there. It's being deferred. I mean, we all love Christmas if you celebrate it, of course. And I think a lot of people are saying, I want to look forward to Christmas and I'll worry about it in January. And I think the market is doing the same. China, again, it's an issue. It's a matured economy, as like again you said with Russ Edwards in your halftime talk this week. They've just announced a new set of quotas for low sulfur oil for exports. That's going to put pressure again on the Singapore market. If the residual part of the barrel and fuel oil has been successful over the last 18 months, really it's the best part of the barrel in COVID times, and look at what's happening with the shipping crisis. It's all added to demand for bunker fuels. More that China produce and sort of start flexing their muscles on fuel oil, it puts pressure on Singapore, which puts pressure on Rotterdam, because a lot of that barrel is arbed in from Rotterdam. That puts pressure on crudes, the high sulfur crudes that Russia produce. It's all linked, and it's just about putting the pieces of the puzzle together. And I think the market will look to do that once the bubble and squeak is finished.
Walter, fairly bearish comments there from Matt Stanley. Back being a bear, he's tired of this bull stuff. But obviously, Walter, China is a very big deal for all oil producers coming out of the Gulf, none more so than Oman. 80% or so of crude coming out of Oman goes to China. What are your thoughts on the outlook or the reporting from China? The data does seem to be somewhat softer than it had been, and the outlook for that country in terms of energy demand.
Yeah, I mean, the data is a bit softer than we expected, but we've seen that before, and demand's held up. So I guess it's a confusing time. What's going to happen next year isn't clear to me, and I think there is there's ups and downs, and I don't really know. I am a bit bearish when I look at my predictions on pricing and hope that it stays up at this level and I get some cream, is the honest answer. So I'm not planning on $85. I can assure you that.
Yeah,
it'd be very nice to keep it through the year.
That might be a little ambitious, but nonetheless, I think there is some sense of where the floor might be. I mean, clearly this lack of investment to CapEx does act as a real foundation, a little ground, it seems to me. Let's go to the survey question and then get final comments. I really want to get people's thoughts on sort of the end of COP26. Does the market need the US to release from SPR to meet demand? Not to somehow try and affect the oil price or whatever. Is there demand for more oil in the US market? And so the US government needs to release rather than to manipulate the oil price. Demand for the oil, yes or no? Carol, looking at the end of the week here in the Middle East, obviously our final session ahead of the ADIPEC, ahead of the end of COP26. Your thoughts on COP, what it has delivered so far, what it might deliver, what could be some takeaways, do you think?
For COP, as I described it once, it's like beauty. It's in the eyes of the beholder. So some people might see it as a major success. Others will see it as a major failure. But there were, for me, what is more interesting, because there isn't much meat in terms of commitment or strong deal on hot issues. But what I found most interesting, and I'm using at the same time, was a statement by John Kerry, the US climate czar, who said that the US will stop using or burning or producing coal, I'm not quite sure, by the end of 2030. That is almost 8 years from now. Bearing in mind that coal represents 10% of the primary energy mix in the US and 25% of it, almost 25% of the power sector. And you wonder what other fuel will fill the gap. Now, they must be definitely putting their hopes on green energy, but that by itself will not be sufficient. So that for me would mean, maybe good times ahead for the natural gas industry, because it would be the most logical and easy substitute for coal. So this is, for me, these are kind of statements. Now, of course, nobody can hold these kind of statements, into account to check if they were met after 8 years. But there seems to be a quite strong dedication from the US to replace coal, but the question is by what?
Matt, I don't think Boris Johnson was expecting the sort of the final days of COP to be headlines in which we're quoting him as saying the UK is not remotely a corrupt country. And without getting sort of sucked down that rabbit hole, your thoughts on the takeaway from COP, and indeed in a post-Brexit world, has it been a big hit for Boris and for the new global UK, so to speak?
Sorry, let me just shut my colleagues up.
Thank
you. Right. No, look, I mean, Boris doesn't know whether he's coming or going at the best of times. I'm not sure he even knows where Glasgow is, if I'm honest, bless him. But look, what did everyone expect to come out of COP? Everyone's going to go, don't worry, we found this new fuel and it's not going to produce any carbon dioxide and everyone's going to be happy and the house is going to be heated and we've got a plan for that to come on board in 10 years' time. No, look, it was just people wanting to get together and shake hands and drink coffee. And the big things I've taken out of it is, vocationally, is what the shipping industry is going to do. I went to a conference yesterday. Do you remember those, Sean? You sort of get together.
I do. I used to organize those things.
Yeah, I remember actually. Yours were quite good. I remember those. Yeah,
they'll be back.
Right, I'm there. No, it was interesting because the global head of oil trading for Maersk was there, and we were talking about transitional fuels and what they're going to do, and he was quite candid, and there was no Chatham House rule. He doesn't see LNG as a future, as any form of transitional fuel for Maersk. They're going to go straight into ammonia and methanol. All their new ships are going to be burning methanol. So the shipping industry specifically is ahead of where the political powers that be, where they are. Biofuels, I know Russ and Euronav, they're thinking about going for that. So since COVID really hit us, that renewable argument has really been accelerated. Rightly so. And the shipping industry being, I think, 2% of global carbon emissions, there are already plans in place. So Fujairah, as the region's biggest bunker hub, they're looking at increasing their infrastructure, whether it be for LNG or green hydrogen. ADNOC have already got plans in place. COP was never going to be anything apart from a lot of noise and understanding and telling the world that we've got point A to get from here where we are, and we've got to get to point B in 38 years' time or whatever it will be. How we get there, they still haven't spoken about. So there's a lot of talk, but the shipping industry has taken the ball by the horns. And I was encouraged what I heard yesterday. I think the Maersk story that LNG isn't the transitional marine fuel is a very interesting point.
Certainly a big one in terms of the idea of building. If Maersk aren't on board, then it's hard to see ports building and investing in that infrastructure to serve the merchant navy. Walter, let's give you the last word this morning with the survey result coming back. Does the market need the release of SPR to meet demand? 2-1 no in this room. Your thoughts on takeaway from COP? I thought the Saudi minister and the OPEC Secretary General sort of walked into the den of opposition there and spoke rather robustly and rather sort of confidently about the posture of fossil fuels in the midst of COP26.
Yeah, I think look, I'm aligned with both Matt and Carol. I think there's going to be a lot of rhetoric about moving away from the hydrocarbons that produce CO2, and we've got to stop this dirty coal. And the rhetoric will come with that. And we're going to go to green energy, and we'll do all these things. The reality is there isn't a robust plan and targets to deal with that. So I'm of the view that what will happen is, the energy mix will still need to be there. There will still need to be a look on price for the politics. We see that it hurts. As soon as price goes up, the politicians jump in, which is exactly what I think this strategic release would be. It's a price mechanism because the prices have gone up. I don't think it's part of the long-term strategy. It's a short-term fix. And I think, actually, and you may hear about this in ADIPEC, I think gas is going to be the fuel that will benefit from it. Easy to get energy from it, and as a replacement from coal, a tremendous advantage. And I think price is going to drive that. I think eventually, of course, we'll get green energy that works very efficiently for all of us. But in the meantime, there's going to be a place for hydrocarbons, and I think a bigger place for gas in that mix.
Okay, well, let's wrap it up there. Indeed, ADIPEC is next week, and we will kick off ADIPEC week on Sunday with a workshop on hydrogen in Abu Dhabi, looking at what a successful consortium needs to look like in order to take those projects forward, which have all of the ingredients of the challenge that LNG presented 30 odd years ago, putting together both the off-taker, the producer, and all of the pieces in between. And so as a result, we will have our first live gathering, as Matt mentioned, in Abu Dhabi this Sunday. And so we won't be doing the webinar on Sunday, because also Christophe Roux will be in Abu Dhabi and distracted. So we will kick off next week on Monday morning live from the floor of ADIPEC, and that should be a bit of fun to get a sort of a sense of what is going on there. I think my 2 pennies worth from COP26, it's all about, from the immediate sort of relevance of this podcast, the continuation of discouraging financial capital moving towards capex. It was there before COP26 started and the months running into it. We come out of COP26 with a continuation of that sentiment. The ability to get funding for fossil fuel investment outside of the national energy sector, I think, will be increasingly more and more difficult. And that's a sentiment thing as much as anything else. And I think that's the big one of the big takeaways from COP26. That's the end of our week. Thank you, Walter, for joining us this morning. Matt and Dr. Carol, really appreciate your insights. Have a great weekend, everybody. And if you're going to be in Abu Dhabi, look forward to seeing everyone at ADIPEC next week. Take care and have a great weekend.